Good morning. It's Friday morning, May the 5th. It's very early in the morning. And I had 13 of my 22 HBI $5 put contracts exercised. And I expect by the end of the business day today, Friday, that all of them will be exercised. But since 13 of them have been exercised, that gives me an opportunity to place an order for execution on Friday, or to be filled on Friday, hopefully, for 13 call contracts. So I want to do that, and this video will cover that. I'm just going to do it nilly-willy and try to edit it up. And okay, let me share that screen. Okay, this is the transaction set chart, and because 13 contracts were exercised before the other 9, I had to break that into 2 lines. The numbers are all the same in terms of the totals, but I broke that out, and I'll be adding another line if I can sell those sell 13 call contracts. So let me try to do that now. Of course, the market's taking a big hit because people are just now understanding that we're going to be in a recession. And the banks that have failed recently are putting the fear into people, and maybe it should. But at any rate, remember, when the stock upon which my contracts are based goes down, I actually have a better free cash flow. Now, it does impact my liquidation value of my account. The last time you saw this was when I placed the orders, and it was over 13,000. So I took a hit, as you can see down here. Not realized, unrealized capital loss of $780 against a premium collected of about that amount. And also I've got the factored into this calculation here is the is factoring in what it would cost to buy out my remaining positions, which I won't do. I'll let them run until expiration. But at any rate, now I need to try to sell some calls. And as you can see, it's not a happy situation. Which would give me $1 spread to cover. And I could do that. The advantage is that would expire today. This is for today. If I go on out to next week, I could go to a 450 strike price. So I think what I'm going to do is do just that. But I'm going to ask 20 cents. So remember, at a 450 call, I've got a 50-cent spread, which I've already collected enough to cover the spread on premiums. So this is still a profitable situation. But I'm spreading these contracts out over 2 weeks instead of one, since I'm doing this next week. Although here, let me correct myself. This is 1 week and 1 day, not 2 weeks, like it was on the original put contracts. It was actually 2 weeks. So that premium that I alluded to earlier was covering 2 weeks. Okay, so I'm going to place that order. As I've stated before, my only real concern about the stock dropping this low in price is the impact it has on the movement versus the increment, the 50-cent increments. The person that bought those contracts only about broke even, because basically I was paid, I believe it was 78 cents a share or 76 cents a share premium on those. And I said $5 put, and and if I just sold them outright now, that's 440. So that's would be a 60-cent spread. So I was still netted about 16 or 18 cents a share profit on that. So don't cry for me. But that's good for the fact that it moved that much and there was that kind of activity. I don't know what the reason was. They bought those contracts. Since I don't buy contracts, I don't get into that mindset. But at any rate, remember, once I sell them, they're traded all around to various people. They may be traded 1,000 times for all I know, and people are trading them based on a few pennies change in the premium amount. So hopefully they made some money, because that keeps them coming back for more. It's like a casino. That's the reason when a slot machine hits the jackpot, it rings all the bells and makes all the noise. That's to remind people that you might be lucky. Of course, the only real winner is the casino, but at any rate. All right, well, let me try to edit this up. I may add something to it. I don't know. This is a real ad lib video, as you can easily tell. But it's important to cover the fact that from the second that I have my contracts orders filled, in the next second somebody could exercise it. They don't have to wait until the expiration date to do that. But if they do exercise them early, then that really works well for me, because I get another day or two. I can sell the puts or calls, whatever is appropriate, early, and that increases my revenue stream. Okay, let me try to edit this thing up. Have a good Friday. It's going to be interesting. The market's really, as I said at the outset, it's really beginning to realize we're going into a recession. The Fed doesn't look like they're going to back off on raising interest rates, and they shouldn't. But the day of, or decade we've had of cheap money is just about over. So all that cheap money is going away from the market. And that's going to bring the market down. Okay. If you haven't subscribed, please do. This is not my best video, but if you like what I'm presenting in this, please hit like. And you want to be notified when I publish a new one, hit notify. Thank you very much. This is an addendum to this video that I'm editing, putting together. I want to address specifically the risk involved with HBI at the current stock price level. And they recently rolled over their debt, pushed out the expiration date of it, although they're paying more interest, which is going to hurt their bottom line. But I don't see any kind of liquidity crisis. They're just going to have some tough sledding until this recession, until the excess inventory caused by this recession is worked through. They're going to have to slow down production. So they'll lay off people but for people who are looking for stock price appreciation, that's not coming very quickly. But I don't look for them to suffer any kind of crisis that would affect their ability to be an ongoing concern. And that's the main thing I'm interested in. As long as their stock is actively traded, then I can make some money at it. Although, as you could see from last week, I did, as some of the previous calls were exercised and that brought in the cash, I rolled some of that over into American Eagle Outfitters, AEO. Now that's also a consumer product, mall-based, and I think they're going to hurt. They've weathered a lot of storms through the years. They've had a great management team. So, but I'm not sure my risk is reduced that much by rolling some of my capital into that. But the stock price is higher, so that gives me a little better position on the 50-cent increment. So I wanted to put that in there. But like I've said before, the biggest danger, if you will, on HBI is that it gets so cheap that it becomes a takeover target. But until the uncertainty of bank failures and whatnot are biased, I don't think anybody's going to take that step or take that risk. So I think everything's going to be working out fine. At least I hope so.